All right. Let's get to it. So today we're going to look at gross domestic product, which is the monetary value, right, in local currency. So it's the monetary value of all final economic goods and services produced within the borders of a country during a specific time. Okay, it is the broadest financial measure of a nation's total economic activity. Some of the keys here is that it is all final goods, right? So when we talk about this, we're not talking about apples as much as we're talking about apple pies. Okay, we're also talking about services along with goods must be produced within the country. All right, then we want to look at 5 ways of using GDP to measure the economy. As we spoke about in the past, we talked about nominal GDP, right, which is just the dollar amount of GDP for the year. We look at the growth rate from one period to the other. Per capita, which is dividing the GDP by population. Real GDP, which is removing inflation. And then debt to GDP ratio, taking our country's debt and looking at it as a ratio of GDP. All right, so those are the 5 ways. Now let's get down to it. We are measuring aggregate output. As we said, it is a monetary measure. One of the things we really want to focus on is avoid multiple counting. So I own an apple orchard and I bring apples down to a local bakery. I sell him those apples. He takes those apples and he puts them in an apple pie or an apple crumble, right? Or an apple donut or something like that. Then when he sells those products, he's including the cost of the apple. So if we measured my sale to him of the apples and then his apple pie, we would be counting that apple twice. So the way to avoid that is to only count the final good. So if Goodyear sells tires to Ford to put on their new cars, the sale of tires to Ford won't count, but the car itself will count in the final production. Okay, and so those are intermediate goods. The tires are intermediate goods, the apples, the cheese that's sold to the pizzeria for a pizza. All right. So when we're looking at this, we want to also exclude financial transactions. What I mean by financial transactions, we mean public transfer payments, welfare, social security, things like that do not count in GDP. Private transfer payments. Okay, any financial transaction, stocks, bonds, things like those. Okay, because we're looking at production. That's the focus you want to be on when you're talking about gross domestic product. What's being produced? If a good or a service is being produced, then employment is being used. Therefore, unemployment should be low if gross domestic product is rising. So that's why we want to focus on GDP. We exclude secondhand sales. If I sell my vehicle, right, so you want to follow this. My vehicle, let's say, is worth $90,000. I sell that vehicle for $40,000. The thought is that I've used up $50,000 of it and the van has $40,000 worth left in it. If we counted me selling the van for $40,000, then the total value of that van would be $130,000 in the market. So we only count the first-time sales. We exclude second-hand sales. So selling the used car to a friend, not in GDP. All right, we have 2 approaches to do the GDP. We have an income approach, which counts income derived from production, wages, rent, interest, income, and profit. I will come back to that. Expenditure approach was one that we focus on the most, and that the AP really focuses on, which counts the sum of money spent buying the final goods. All right, and then the question is, who buys the goods? So let's look at these approaches, and let's break them down. So we have the expenditure approach. Okay, we break it down into 4 categories. So see, each one of these is like a cash register at a big box store. And they're going to total up all the consumption by households, right? So people buying things will count in that column. Then we'll have investment by business. When we talk about investment, we're talking about capital, the tools that go into making consumer goods. So in this case, you could have someone like Mach down in business who buys a pickup truck so he can plow the snow. That truck would be counted in investment by business. Mr. Duggan buys a pickup truck for personal use, that would count in consumption, even though they both could be buying the same one. I bought the same lawnmower as a landscaping company, right? We went to the register, we paid the same amount. The only difference was when counting GDP, they would put mine in this category and the landscapers here, because that lawnmower was going to help produce a consumer good. Then we have government purchases. Notice the word purchases, not government spending. Government spending includes transfer payments, welfare, Social Security, unemployment insurance. Those things do not count in GDP. The government buys a submarine, that counts in GDP. The government builds a highway, that counts in GDP. Okay, and then the next one is expenditures by foreigners. So every good we sell to a foreigner adds to our GDP. However, every good we buy from a foreigner deducts from our GDP. So our expenditure one in our country is usually a negative number. Then we go to the income approach. What you want to look at the income approaches and want you to notice, wages is what we pay labor. Rent is what we pay for land. Interest is the cost of capital. Profits is the cost of the entrepreneur. So the income approach takes the four factors of production and their cost, adds those up, and that's the income approach. There is a slight statistical adjustment on this, right? Also, you could look at this as the upper half of a circular flow diagram, and this is the resource market. This one goes through the product market, this goes through the resource market, right? But both of them equal GDP. So let's look at the expenditure approach. We look at personal consumption, durable goods, goods that last more than a year, non-durable goods, goods that don't last a year, okay? And any expenditure we pay on service. I go to get my hair cut, that is a service that's being provided, that will count in GDP. Okay, then we have investment. What we mean by gross private domestic investment, it means any investment in the economy by firms on things like machinery, equipment, and tools. We also look at net investment, okay, net private domestic investment. Basically, if I'm replacing a machine, there is no gain in investment. So if there is a monitor in the room and we replace that monitor, the investment hasn't changed. If we add another monitor, then net private domestic investment increases. Okay? All right, we look at construction, creation of new capital assets. This one, the investment is looked at as the engine of a train. It may be the smaller of the expenditure approaches, but it's the one that drives. Because if I'm investing in capital, then I'm probably hiring workers. Workers are building the factories. Workers have money, they spend money. Okay? Then we go to the third one, which is government purchases. Expenditures for goods and services, expenditures for publicly owned capital, bridges, roads, hospitals, schools. We exclude transfer payments. Then the one I talked about just before is net exports, right? So what that means is we add up the exported goods and we subtract imported goods, which means X of N, which is exports minus imports. So now we have a formula for GDP. GDP is equal to consumption plus gross investment plus government plus net exports. All right, if you wanted that an abbreviation, exports are X and then the imports is an M. So X minus M gives you X sub N. All right, let's take one more slide and then let's look at what is gross domestic, what is it and how does it affect you? All right, so if you look here, 69% of GDP, which we talked about the other day in class, was $21 trillion. 70% of that comes from personal consumption, right? Then 17% comes from government. It says spending, it should be purchases. Here we have business investment. This is the capital. And then over here we have a -5, which means we import 5% more than we export. All right? One of the things we will look at during this year is this government spending or purchases is probably a lot bigger now than it was prior to the pandemic, right? And the business investment one, I would guess, is a little bit smaller. And personal consumption would be an interesting one to check, which is what we will do going forward. Okay, boys and girls, I will see you on the flip side.